Hello guys. So today live session is about how to use put options. Now the reason for that is that a lot of people complain, like beginners. They always complain, oh, where are the good stocks? We don't find good stocks. I buy a stock today, tomorrow it goes down. So always your stocks are going down. So I give you a solution to that. Okay? Solution to this problem that you are facing. The solution is, if you don't know how to sell short, or you think it is dangerous for you, don't do that, especially when you are a beginner. If you want to do it, selling short, you can do it as a day trade, because you control a lot and you see the price and you can exit at any time without wasting a lot of money. But I don't recommend to do selling short as a swing trading. Okay, it means especially if you are doing penny stocks, never sell short penny stocks in swing trading. It means when you hold for many days. This is a big problem. Okay, if you want to do selling short, you can do it in day trading, which is very good. Why? Because in day trading, when you sell short and then you put stop loss, if something goes wrong, you exit. But if the penny stocks are very dangerous to sell short, so be careful. Okay, now let's go to another thing which we speak about, which is how to use put options. Now this is a solution to all the people that they say, oh, my stock is going down, or my stocks I got are going down. So this is the thing. Okay, now let's greet some people here. We have Oran Pronobis. Hello Oran Pronobis. Hello Shikar Sood. Hello Shikar Sood. Oran Pronobis said selling short is great for scalping. Now whatever you want to do when you are a day trader, when you are doing scalping or some other things, okay, so scalping, if you are doing scalping, you need to put too much money in the trade to make money, okay, because you are staying just little, except when the stock is very volatile. Free trader, hi everyone, how are you? Oran Pronobis said, no overnight shorts dangerous. Yes, you should not do selling short and holding the stock for overnight, especially penny stocks. Believe it or not, there are many people, they get into debt because they play with something that it is so dangerous. Now understand, because we are speaking right now about selling short, that selling short for penny stocks can make you in debt. What does it mean? It means that you can be in debt and the broker will call you in the morning, which is called the margin call, and he will ask you to bring all that money. Now before we go to another question with Shikar Sood, okay, before we go to that, let's explain to you this. I have explained many times, but understand that there are a lot of people, they don't understand how sometimes it is so dangerous. Okay, it's so dangerous to play this game of selling short. Now I will give you just an example, and then we can go to Shikar Sud question. Okay? Now, Ora Pronobis, please, and Shikar Sud, please wait for me. I'm trying to go to explain this because a lot of people they don't understand fully what does it mean. And sometimes these new guys, they are beginners, they just begin to learn what is selling short, and they tell them, oh, the stock, you see that stock, it was $5, today it is $1, and you can make tons of money just by selling short and just leaving the stock. But they don't tell them, those people who teach, they don't teach them how dangerous is penny stocks. Okay, so I will give you an example. Okay, so let's go. Okay, now here is an example. Okay, let's see. I see that yes, I see that I don't see the explanation to draw things. So are you looking? I don't see. Oh yes. Oh, okay. So please try just to. I will explain to you this, and then I go to the questions. Okay. Now listen. Let's say, okay, a penny stock. Okay, here a penny stock is going down. It's going down so good. So let's say it was $2. It has gone to $1 today. So from $2 to $1, okay? So 50% going down. So the people who short from $2 to $1 here, they are making 50%, okay, as profit. Now for you think that this each candlestick is 1 day, second, third, fourth day. Now today, for example, let's say today is Friday, just an example. Okay, now here is Monday. So you see this stock XYZ is going down from $2 to $1 for many days, 1, 2, 3, 4 days, and the people have been making 50%. And you say to yourself, why not me? Why for example, I enter here at 1 and the stock can collapse more and I make money to 50 cents or something. And fortunately for you guys, okay, tomorrow we have a very big candlestick and the stock goes from $1 to $5. Just an example, okay? I'm just saying this example. It can happen, yes or no. It doesn't matter. For me, I just show you how bad it is when you hold overnight penny stock. So from $1 to $5, do you understand? If you put $1,000, do you know how much money you lost? So here you lost $5,000. Now your money is erased. So the broker will call you and he will ask you right away to put $4,000 into your account immediately. And this is called margin call. Okay? This is called margin call. So understand that you have lost 500% of your money. 500% from 1 to 5. Now, that's why it is better not to play with penny stocks and holding them for tonight, for the overnight. Now, this risk, even this risk has never happened to this stock. You see the stock, it's all good. But if one day a bad day comes to this stock, or good day to the stock, you will be having a lot of troubles. That's why for me, it's here the risk is unexpected. Unexpected, you will never know how much you lose. Okay? So be careful of this. This is just to explain how bad is penny stocks in what we call selling short. Okay? So let's go to the questions. Now let's begin with Shikar Sood. I want to ask how to trade 52-week high stocks as they are already going up and are in a trend and we enter late into them. Now, Shikar Sood, try to understand that here I am not teaching for the training for free. So you are asking, I know you are my student, you are asking something related to the training that I am doing and the strategies I'm doing. So please send me an email. I will explain this by email. Okay? Now, Oral Pronobi said penny stocks are prone to halts, delistings, and do not adhere to technical analysis and are pumped and damped. Yes. Oral Pronobis, I'm telling you something. There are two kinds of penny stocks. Some, they are not pump and dump scheme stocks. And some are regular penny stocks that you can follow. Okay? So there are two kinds. Now, how do you know about them? Is volatility in the stock. I will show you, I will describe this and I will show you how things will go, okay? By having the thing. So let's do this. Now, look here. Now, here are two penny stocks. Okay, two penny stocks. One here is volatile, or it could be even volatile, but it could be even pump and dump scheme. I will explain. We have seen this many times, but I will explain again. Okay, and this is normal penny stocks. There are what we call normal penny stocks. I will show you. Normal penny stocks, when they move with, let's say, like this. Okay. I just give you an example. Please bear with me. I just show you how this can work. Okay. So you see that these stocks, when they move, they have a normal trend. We have going up, we have correction, going up, correction, going up, and then it might be correction. These are normal stocks, and I follow some stocks like these in penny stocks. Now, but those that are volatile, there are two kinds. Two kinds, for example, like this. This stock goes from $1, it goes down to 50 cents. So this is too much. And then the next day, it goes maybe from 50 cents to $1. So these stocks are very, very volatile. So if you want to trade, and then, for example, they go down like this, they go down more, they can make a small green candlestick, then they make a big. So when you see this chart, you understand that this stock has no clear trend. It's manipulated. It's very volatile. There is a lot of manipulation here. So you can't follow the trend. So here we have a clear trend that you can follow. And this is what I follow. Trends that are normal. Now this is called volatile stocks. So most of the penny stocks are like this. It means when they move, they don't make a good trend. Now, then we go to the second volatile, but this is a big manipulation, pump and dump scheme. Pump and dump scheme, what does it mean? I can show it to you here. Is you find stocks that are the stock that it is moving very little, it doesn't show anything. It goes only 1 cent, 2 cents, 5 cents like this, and you can see. Let's say the day. Let's say today here or yesterday, the volume is 25,000, and the stock is $1. Just an example, okay? And the chart is always like this. It's always doing nothing. It's not like this very, very volatile, but it does nothing. Now, the volume is 25,000. And then tomorrow, this stock goes from $1, it goes to, let's say, just an example, to $4, making a 400% up. Now, you ask yourself and you begin searching for these stocks. These stocks, you can find them in day trading. Yes, you can find these stocks. They are very volatile. They can go up or they can go down as much as they do. Or they can go down also like this. From $1, they can go, let's say, to 10 cents next day. Because we have a pump and dump scheme. There is something going wrong. There are some people who are manipulating the stock. So either it can go up or can go down, and the stock can lose a lot of money. So if you want to trade penny stocks, you should use normal stocks that I describe in training level 10. How to trade penny stocks. I describe these stocks, how can they move, and what's normal and what's not normal. Now, volatile stocks like these here, like I showed you, like for example they are just going up and going down. You don't understand why they go up, and you don't understand why they go down. So we have here day traders that are playing each day. Sometimes they go down, sometimes they go up, depending, and they are just doing a play in the stock. And sometimes you find pump and dump scheme. You find a very low stock doing nothing, and then one day or two it changes everything to something unexpected, and then here you find 15 million volume. How can a stock with 25k goes to 15 million next day, without any news. It means if there is a news, I understand. For example, earning news, and this company has made a large profits, and you will see a gap up or gap down. This is normal. This is normal. But what is not normal is that there is no news. You go to the company and you find no news. It's just the stock was $1, it goes to $4. The stock is $1 and then it goes to 10 cents. And you don't understand why. Fundamental, it means when you are asking, you are saying why this stock has jumped here and there, you don't understand anything, and this is manipulated stocks at called pump and dump scheme. They make it go up, they make it go down according to certain schemes that it is forbidden in stock market, but it happens always. It happens, and no one can stop it. Okay. Now, let's go to our questions. Oral Proverby said, penny stocks are prone to halts the listing and do not adhere to technical analysis and are pumped and dumped. Yes, this is Oral Proverby. This is what I explained here, and I showed you how things work. Okay, I showed you why this kind of stocks in penny stocks, how they are doing. Okay, now let's go to another question. Oral Proverby said also reverse splits in penny stocks. No. Listen. Oral Proverby, reversed splits in penny stocks or in other kind of stocks has nothing to do with what I am talking about, because reverse splits do not change. You don't lose money. Okay? So maybe you are confused with something else. So I see that that the video is not doing so good today, but it's okay. I'm trying to explain. I understand that maybe you are listening very well, but you don't see the video very well. So I will just go and explain by diagram what does it mean a reversed split, and I will show you that this you don't lose money because it's the same. You have the same money. Okay, so Oral Proverby, I will explain that and hope it's working. Now let's go to what he said. What he said is what we call reversed splits. Okay, reverse splits. Now, what does it mean, a reverse split? Okay, let's say the stock is now $1. Now, $1, the company, because the one who do splits is the company itself. XYZ, this company is $1, and this company wants to make the stock more respected. Let's say it wants to make the stock to go to $10 a share, not $1. Now, this is today. This is today. Today. Okay. And this is tomorrow when we have the reverse. Okay? Now, why the company do a reverse split? It means that she wants to show to the investors that the stock, it's not $1 anymore, it's $10. Now, when it is $10, there are many investors that they like $10 and they don't like $1 because, you know, some related to fundamentals and other things. So, I will give you an example. Okay? Now, let's say you have your money in this stock is $1,000. So, $1,000. So, you own 1,000 shares of this stock. 1,000 shares. It means you bought 1,000 shares with $1,000 because the stock is $1 a share. Now, tomorrow what will happen? Tomorrow you will see that you have in your account, it's the same money, which is $1,000. It's the same money. Now, what is the thing that changed? Your stock now is $10. It's not $1, it's $10. The second thing is you don't have 1,000. You have only 100 shares. So 100 by 10, we have 1,000. 1,000 shares by $1, you will have 1,000 accounts. So this has nothing to do with what we are talking about. This is not a pump and dump scheme. This is just a reverse split. So understand the problem is that this has nothing to do with what we are talking about. So you don't lose here. Yes, the share price change, your shares number change, but your money is the same. So you are not losing any money. Okay? So please try to understand that this has nothing to do with what we are talking about. Okay? Because we are talking about pump and dump scheme. When you lose money, here you don't lose. You don't lose any money. Okay? So let's. Oh, okay. Thank you very much. Now the live stream, I think it's good. I think it's better than before. Now let's continue our discussion. Now, me, myself, and I said, hello, Karim, are we heading back into a bear market? Now, we have a question. There is a problem in the live session. Now it is good. I can see it. It's good. So hope you are watching and it is very good for you guys. Now, as I explained right now, me, myself, and I said, hello, Karim, are we heading back into a bear market? Now, understand that this week is weak. Do you remember? When I say 9 weeks from 26 December, it is a strong weeks. This week is very weak. Now, you are telling me, are we heading in a bear market? No. A bear market is when we hit the low of last year. So we are not there yet. This is just a correction in the trend. Now, how do we know that this correction is not a downtrend, not a bear market, but it is a downtrend? So you should understand the difference between a bear market and a correction. I have explained last year, the whole year, explaining the difference. Okay, so let's give you an example to understand this. Okay, so let's go. I will give you the example of Dow Jones. Now, Dow Jones last year was going down, okay, and it stops going down here. 26th of December here begins the new trend. Now it is going down. Okay, look at this. So let's drink some coffee. Okay, now this what you see is called a correction. It's not a bear, it's correction. Correction, it means when the trend is going so good, 9 weeks is strong. Now this week is weak. Weak, it means it's going down. Now how do you call this? It stops for today here. Now if it continues to go down, this is called a downtrend. It's not a bear market, a downtrend. It can stop at any moment and it can go up. So we will never know. Okay, now it is the first week is weak. If we have second week, third week, fourth week, we are going into a downtrend. Now when we say that it is a bear market is when to reach this line here. If we go to this line from the downtrend and we cross down, this is a bear market. It means everything could be going down for sure. So you understand? Is it all clear right now? So now this week is a week and it is called correction. If it continues, it is called a downtrend. If it hit this line, which is the low of the 26th December 2018, if it hit that, we say that we are in a bear market. Okay? So hope is clear. So me and myself and I hope this is clear for you guys. Tesla said, hi, are you talking about BPTH? No, I am not talking about any stock. I am talking about Dow Jones. Okay, so me, myself, and I say, yes, I understand, thank you. Okay, welcome. So Tesla, you told me, are you talking about BPTH? No, I am talking about Dow Jones. Okay, I'm talking about Dow Jones and how it is doing. Please, guys, I see the live, it is very good, but I see a black screen. So can you tell me what are you looking on the screen? On the screen, what do you see? Because here, for me, I'm looking at a black screen and it's like buffing. But it says live stream, so I don't understand if this is good or no. So guys, you see me? Okay. So yes, very good. So for me, I'm looking at I I'm it says live stream, but I'm looking at a black screen. So there is a problem with this today. Although it says it is an excellent stream. I don't know what's the problem. So I will try to refresh it and see if things go good again. No, yes. Thank you very much. I'm looking at the live. It's so good. Okay, so let's now talk about how to use put options, because a lot of guys send me emails and I see some comments when I do speak about options. They told me how do we use them. Now what I said is, since most of you guys, you are always finding stocks that are doing bad, so why not you change your strategy and you find these stocks with your strategies and then buy put options. Now put options is very easy. If the stock goes down, you will be making money. So all the stocks that you see that are doing bad, why you don't go and buy put options? Hello, Peter Martin. So for me, I have made another ebook called When to Buy Exactly Call and Put Options. I have 2 training about that. So if you are interested, you can go later and check them. They are in the description. It means you go to the description here and you just check them if you are interested. Okay, so let's say to change, because I put, okay, here under the description you read and then you find 2 of my one is an ebook and the other is videos, an ebook. So what is the thing? You go to the stock market, you find thousands of stocks going down. You pick the stock that you like, that it is going down, and you buy a put option against it. Is that easy? Yes. But to buy exactly as I buy, you should have some kind of signal and search. And this is where you need my expertise. It means you need where exactly to buy and how to know that this will be the beginning of the downtrend. Because the downtrend, we will never know how long it will stay. It can stay 1 week, 2 weeks, 1 month, 2 months, 6 months, 1 year, 2 years. Okay, so there are some stocks that go too much, like we have seen last year. GE, for 1.5 years it was going down from 32, it goes until $8 or $9. So you see, if you have bought a very long put, you will be making a lot of money from this. And you can just, if you want to not to stay too much, you can stay 1 week or 2. The stock is going down, you will be making some money, and you just sell your put option with money. Okay, so but if you want to understand where to buy exactly the call and the put options, you need to see my training. Okay. Peter Martin, you say hello, Karim. Hello, Peter. Hasti, he said, at what strike price do you recommending buying options? Right at the money or a few away from the money? Now listen, for me, I like either at the money, it means from today, at the money, or out of the money. Now, why? Out of the money, you buy only the time, which is called extrinsic value. You don't buy any value, intrinsic value of the option. It has no value, but you buy only the time. For example, you are buying 2 weeks. So when you're buying 2 weeks, you check what is the strike and you buy it. Let's say, for example, if you buy at the money, it is $1. But when you buy out of the money, you can buy it at 50 cents, 20 cents, 10 cents. Now, if you think that the stock will go that much, you can make it. Now, before I continue with this, so let's greet Nazdinanochi. Hello everyone, bonsoir, Karim, I am late today. No, you are not late. Yeah, you are late because we begin at 11. You are too late because we begin at 10 almost all Fridays. But last Friday and this Friday I have changed and put it 11 because some people, they come late and they tell me, oh, we are late. So I want just to adjust this. So that's Dunanachi. I like the hat that you are always putting like Rasta or something. It's very nice. I like it. So, and your glasses, you know, it's like you are a sci-fi guy, okay? So it's very good. Now, let's now explain to Hasti who speak about the strike. Okay? So let's go to explanation. I want just to give more information as always, as you understand, guys, that I'm always trying to help as much as you can. Okay. So let's explain this thing. Now, let's say the ask, it means when you go to the option, the ask is at the money. It is $1. This is what you pay. It means you pay $100 for the contract, okay? So because 1, you multiply by 100 shares. So it is $100. You pay $100, okay? Now, the stock is called XYZ. So this is just not a real stock. It is just virtual. Now, let's say the stock is $32 and at the money it should be 32. This is called at the money. Now, at the money. At the money, it means the price of today. This is at the money. And this is the strike here is 32. Now, since the strike is 32 and the price of the stock today is 32, this is called at the money. So you are buying this one contract. You are buying one contract at $1. So you spend $100. That's it. Now, you expect that this $1, that this stock, $32, this stock XYZ, this is 32. You expect that the stock will go down, okay? Let's say to 20. Just an example, okay? You are expecting that this stock is going to a downtrend. It's going down. And you say to yourself, if this stock is 32 and it might go to $20 because it is going down, today I buy at the money $100. Now you get the idea that if you are going to buy a put option, because here we are speaking about put, okay? If you are buying a put option, let's say at $29, this is the strike. This is the strike. You end up buying it cheaper. Let's say 50 cents. So you are spending only $50 because you are buying only the time. And this is called out of the money. Out of the money. It means, what does it mean, out of the money in options? It means that your option has no value in terms of money. It has no value. Now, if the option has no value, why you are paying $50 for this? It's just because $50, it is because of the time, because you are buying time. This time it is called extensive value. You are buying only time. You are not buying intrinsic value. That's why I can't tell you what you buy. It's your choice. But if you think that the stock will continue to go downtrend, you can buy it cheaper. Sometimes if you go down for the strike, you can choose, for example, $25 strike. Maybe you find it with 10 cents and you spend only $10. If the stock goes to 25 and continues to go down, you will be making a lot of money because this 10 cents will go up. Now, if you ask me, what do you recommend? I don't recommend anything. But the best thing is from at the money and going down. This is the best thing. It depends on you how much money you want to risk. If you want it cheaper, you should go with out of the money. If you want just normal, you should go at the money. Because at the money, 32 and the price is 32. So the strike is 32, the price is 32. It means you are buying from today. It means you can expect anything next week. If you want to buy cheaper, you should go down. And then your option is out of the money and it has no value. Now you tell me why I pay $50? Because of the time. You buy time. Understand that in options you should buy time. In stocks we don't buy time. In stocks we have only here extrinsic. We have only the value of the stock. We don't have the value of time. So you are not paying to stay. Here it's like a hotel. Options is like a hotel. The more you want to stay, the more you pay for the time. Plus, you pay for the value of the option. So hope you understand this stuff. And hope you guys, hasty, please, after you have seen my explanation, please, if you have any other question, please ask. And Hasti, in this description, I have two training, one in videos and one in ebooks, and you can check them if you want more details, things on where to buy, because this is specific for options, call and put options. Okay. Hasti said at the money, it's a lot of more volatile, though, which could be a good thing and a bad thing. No, don't think about that. Think that because you bought it today at the same price of the stock, it doesn't mean it is volatile or not. No. The volatility depends on the stock. If the stock is volatile or it's not volatile. Because what does this put option do? Put option, it follows the stock. If it is volatile, the option will be volatile. If it is not volatile, the option will not be volatile. So it just follows and it tracks the stock asset, okay, which is called underlying assets. Okay, so try not to speak about options as they are separate. A put option is not separate from the stock. It follows the stock. Yes, it has its own calculation, but it is different. Okay, so thank you very much, Hasti, for this question. Now, Peter Martin said, can you use a put option to hedge a position in the same stock? Yes, but understand that you can't be smarter than the market. You can't be in two directions and you think you can make money. You can't. You will understand this by the movement of the stock or the option. I will just try to give you an example, but this you need, Peter, you need to calculate how much you spend on the option and how much you lose from the stock. Okay, so let's say here, I will just try to make sure you understand this. So let's say you bought a stock at 32. Let's say you bought 100 shares. I just give you this example, very simple example. Here. And you bought against it a put option. Okay. Let's say you spend $100 and you buy one contract. Okay. Now let's say the stock has gone to $30. So here you have lost $200 minus, this is the loss. Now, for $2 here, it doesn't mean that you can get $2 in your option. It means $200. Okay? So this depends on some other calculations. So you are not getting $200 and plus $200 and then you break even. You break even. You don't lose. You don't make money. Now, let's say you get $40. Just an example. Okay, you are getting $40. Here you lost $200, but you are getting $200. Okay. Now let's say the stock moves again to 32. Okay. So here you lose nothing. Now from $30 to 32, you make this to $200, so you break even here. But here, what will happen to you? Okay, you will be losing some money from the put option, and understand that the calculations, it is so difficult to manage. Okay, so when you think about hedging, okay, hedging, most of the time mutual funds are doing hedging because they can't sell short mutual funds. But mutual funds, when they lose, if the stocks are going up again, and they lose all these put options, okay, they don't care that much because it's not their money. But you, even if the stock goes back, you will be losing money from your put option because the calculations are so different. So what is the bottom line I'm telling you? The bottom line is you can't be in two different directions and you make money. Okay? And you can't just break even. You think that you can break even. There is a lot of calculations you can do, but it is very hard to break even. Most of the time you lose some money. Most of the time you lose some money. In order to do these calculations, you should follow the same stuff with an option, how many contracts you buy, and you should do it for many times and see the calculations. Okay, because for me, I can't give you calculations, and the calculations are done by the exchange, and it is very complicated calculations. It's not simple calculation. So don't think that when you hedge you are going to make money, but most of the time you will be losing little money if the stock is. But what if you bought 500 shares? What if you buy 500 shares? How many puts you want to buy? Okay? Because 500 shares, you lose here $1,000. Now, in order to make $1,000 here, how many contracts you should buy? This needs calculations. And if the market has reversed and go up again, you are going to lose a lot of money from this $1,000 that you made here. So it needs a lot of calculations, and it's you should make a plan and do it even virtually. You don't need to buy really. You can do virtually, and you can do that. Okay. So thank you very much, Hasti, and thank you very much for asking the questions. And thank you, Peter, for asking this question about hedging. So Peter is to stop loss, Kareem. Yes, you can hedge and you can put stop loss also, but understand that most of the time when you are in two directions, you can't tell me that you are in North Carolina and you want to go at the same time. You go to New York in the north and Miami in the south. You can't do that, except if you have a twin and people they don't realize that there is a twin and one is going north and the other is going south. So that's why the market only gives you one direction that it is correct. Either you are correct or you are false. Okay, you can't be both in stock market. That's why they say the trend is your friend. If there is an uptrend and you are in the trend and you can make a lot of money because you are right. But whatever the trend is going up and you are going down, you sell short, for example. So here you are against the trend, so you are losing money. Hasti said, the Greeks are complicated. Yes. One of my training about, I explain the Greeks, but they are very, very difficult. Because these calculations are done by the exchange. It's not you. And you will never know how the price will be. Because if the stock goes up with $1, it doesn't mean that your option will go $1. It will never go $1. Okay? So it's not like stocks. So in stocks, it's very simple. Any stupid person, even in 5th grader, okay, he can understand the stock market prices, because it was $1 and then it goes to $2. It means that the stock is going up. From $2 it goes to $1. It means the stock is going down. It is so simple and precise. Because what makes you a winner or a loser is when you buy the stock and the direction of the trend. Okay? So that's why if you want to specialize in options, you should do a lot of calculations by yourself if you want to hedge or if you want to do. But in general, what I'm speaking in this live session, how to use put options, it's very simple. A stock is going down, you buy put option. If it continues to go down, you make money. Is that simple? Yes. But in order to be profitable in the future, you should know when to buy exactly, and to do risk calculations, how much you put, how many contracts you buy, okay? And don't play with options a lot, especially if you think you know the direction. This is one of the biggest mistakes that wipe out your account. If you think that the stock is going down today, you buy all your account, you buy put options. Oh, tomorrow it will go down. I am sure. But tomorrow it will go up. So all your money will be gone. Because understand that options is a leveraged vehicle of making money. It's leveraged. It means with small money, you can make high percentage. But understand when you put a very large money, understand that the percentage is big and you can lose a lot of money. Yes, you can make money, but understand that we are talking always about risk. Don't think about money, think about risk first. Tesla said, do you buy stocks all-time high? No. I bought very low 9 weeks ago. When I am saying there is a reverse in the trend, I showed you. So Tesla, you are with me from last year. And I'm telling you, when there is a trend from the down to up, I am in. So I bought a lot of stocks when this trend in Dow Jones, S&P 500 and Russell, I bought a lot of stocks and I make a lot of money. Now, I will show you again, because I think most of the time, people, they forgot. Now, look at the Dow Jones. This is when there is a reverse. I bought the stocks all the way. So you see, this 9 weeks, this is a 9 weeks. Now, this week is weak. I just explained. Okay, this is weak. So you are not going to buy here because it is so weak and we don't know. Maybe it's going down into a downtrend. I have just explained that. So be careful. Okay, be careful of that. So Another thing, Tesla, you don't know. I have many strategies according to the mood of the market. When the market is so good, and as you said, making new highs and the other stuff, when there are big trends, I follow them. When the market is down and there is a reverse, I try to be there. But it doesn't mean that I know 100% that the stocks will go up. But I bet my money on stocks. When I see something that I know, I do bet on stocks. But it doesn't mean that I will succeed. No. It means that I follow my instructions and my signals. I don't care about the market. I care where I should buy, and the confirmation comes from the market later. 1 week, 2 weeks, 3 weeks, and I will see if I am good or no. If I am not good, I will exit all my stocks with a stop loss. I am not staying with the loser. That's the way I do you buy stocks outperform the S&P 500? Yes. Yes. If you see Facebook and Twitter, Facebook and Apple outperformed Dow Jones. But right now they are weak. But before they were so strong. So I will show you. Because I think you want to know. I will show you. Now let's take Dow Jones. Let's take, for example, Apple. Now you see Apple. Okay. Let's take all these lines just to show you. Now Apple. You see Apple right now. Okay. Now I have been into this, all this trend, and I've explained a lot of times, and explained when I exit, when there is a downtrend. So this is the downtrend. So let's compare. Comparison. Whenever you have Apple or any stock, go to setting, go comparison, and put Dow Jones. Listen. Look at this. Look. When Apple outperforms, see this? Do you see all this trend here? It outperformed Dow Jones. Now it is the same as Dow Jones. Now it is the same. Look. Although it goes above it better than Dow Jones, but still, in the past, look, do you see these highs? Do you see this 233? Now here, this is the trend that I was in. Dow Jones was doing some trend, but it was very weak. So if I bought, let's say I bought Dow Jones ETF, I will be not making that much money. But understand that when the trend finishes, I exit because there is a downtrend. So for me, I am not going to stay in a downtrend because I lose my money. I lose my profits. That's why I exit on time. To find these trends, you should follow my strategies. And this is the deal. Okay, so Tesla, you have been watching me from last year, and when I explain things, and I say what I expect and what I should do if these things happen. This is all is according to what I believe in as criteria and techniques. So these things, you will never find them online as free. No one is going to explain this information for everybody for free. That's why I make my training. Now, Hasty said, don't chase, wait for a pullback or some type of consolidation. Yes, but understand, Hasty, that when you say don't chase, wait for a pullback, but you know, people, they don't understand what is this pullback until the trend is big and they see it, and people, they begin to talk about it. Because people who don't trade, they talk when the thing is clear for everybody, they talk. But when it is not clear, the beginners, they will never buy. If you show them something, they will never buy. Now, why is that? Because they don't see the trend. But I see the beginning of the trend, but they don't see it. Now, how do I see it? Techniques and signals. I use my criteria. This is what makes me trade. I'm not using moving averages or indicators or some stupid guy, I follow him. No, I don't do that. I do according to what I believe is correct from my point of view. If I find opportunity, I buy. I don't ask someone else or go to an analyst or go to a guru online and I will see what he says about my stock. No, I will do what I have to do. Okay? Peter Martin said, when the market is weak like it is this week, do you then sell all of the stocks you bought previously? Yes. If the stocks reach my stop loss, I will exit no matter what. I don't wait. Because, think about it, Peter. Okay? Think about it. I will just show you a diagram and explain this to understand how I do it in general. Okay? Now, this is a trend I am following. Okay? Let's say this is my stop loss. I don't give you numbers because this is something that it depends on many things. So stop loss, this is not called stop loss, but I call it the exit point because it's not stop loss, because I'm not losing. Exit. Okay, I'm sorry. I will change the word. Okay, so I call it. Let's say I bought a stock at 100. Now is 130. Just an example, okay? Now it is today. Today is here. This is today. $130. I bought it. I buy at 100. Okay? Now, this was here my stop loss. This is the initial stop loss. This is called initial, the first stop loss I use. And then when the stock is moving up, I have some techniques to know if the trend is weak or strong. Now, let's say my exit point is here. If the stock is not doing good, my exit point is here. Let's say the stock goes down and crosses. Now I am out. Out with my profits. I have my profits, I'm out. Now, 3 weeks it's going down. Now, after 3 weeks, it's going up again. It crosses. I buy again. If it continues, I will be making more money. Okay? So, for me, I can buy from the bottom, but this bottom is very hard to know. It's very hard. The easiest one is when I see that the market is very, very strong. Okay? So this is just how I follow the trend. And this is training level 7, how to follow the trend. This is how I follow. But the techniques, how I know, or where I put my exit point, or how do I know this stock is weak, this is our techniques used in training level 7. Okay? Now, so as I told you, when I sell because of the market is weak, yes. Because if the stock continues to go down, what does it mean for me? It is eating a lot of my profits. Let's say I buy 500 shares or 1,000 shares. Let's say an example. Do you understand that it is $1? If you buy 100 shares only, you are losing 100. Let's say if you buy 1,000 shares, it means for each dollar down, you are losing $1,000. If it goes $5, it means $5,000. Like this. So understand, it depends on how big is your position and how much you lose or how much you make money. So it all depends on that. So following the trends, in general, it's not that hard, but it needs a lot of practice and to follow instructions. So, since we are continuing to speak about put options, I say that put options, since you or anyone else is following stocks and the stocks that they follow, they go down. Why not to buy put options? Now, there is another thing I will tell you about fundamentals. I will show you. Okay? Just an example. Now, we take, for example, an example of a stock from last year, which is called GE, which is General Electric. Just an example, okay? General Electric was in the 30 stocks in Dow Jones. Now, what happened these 2 years? What happened to this GE? While the Dow Jones are going up, this GE here, it was here, for example, is going down, while the Dow Jones are going up. So what does it mean? It was 32, it goes to, I think, 9 or 10 in the low. Okay? So what does it mean? It means that GE going down, it means its fundamentals is having problems. When the mutual funds, okay, just an example, they study, for example, they bought this GE when it's going up, but when it is going down and they see that the index is going up, they understand that there is something wrong with the fundamentals. What they do? They go to GE and they study it. They study the financial statement. They see what's wrong. Now, for example, they find something bad, that the earnings are going down each quarter. Each quarter, the earnings are going down. It means that GE is not making good money and it is losing money. So what they do? They begin to sell off. Now, they can't sell in one day, but they can sell in many months. So many months, there is a sell-off. Investors, they see that the stock is going down too much. They begin to sell, and everybody selling. And hedge funds, they come and they sell short because this stock has problems. So all these people are selling. Mutual funds are selling off. Investors are selling off. Hedge funds are selling short. So this is the opportunity to buy put options. This is the opportunity I show you to buy put options. Now you tell me, how do you find these stocks? Now you should search. And you should search, and in my training, when to buy exactly, this is just an ebook, call and put options. I make it in an ebook, a new ebook, and you find it just an ebook. I don't do a video for it. So if you go to my description, you find it. Want to buy exactly call and put options. This is where I showed you exactly where you should buy put and call options according to my strategies. Because my strategies is for stocks and for options, it's the same. It's the same thing. It is just when to buy. Because the put option is the same when you sell short. Is the same. Call is when you go long. So this is where I show you exactly where things go. Okay? Now let's go and see other questions. So another question from Hassi. Are you a full-time trader? Yes. Full-time trader, I don't do day trading, which is easier for me. That's why I have time. So all my money in the market, I buy stocks for a short term and long term. It means swing trading. This is what I do. Okay? That's why I have more time for myself to do whatever I want. Okay? If you are a day trader, it will be more difficult because you should wake up early, you find the news, you find stocks, you follow the mood of the market, you follow the news of the stocks, what is going on. Whatever news is good for you because you can see if there is a possibility to sell short or to go long, depending on the news. But for me, I don't use news. I don't care about what a company has as a news. The only thing that it is very important for me is to check the earning news because it is very, very important. Sometimes you have a gap up, sometimes you have gap down. So this is the most important thing I see in my stocks. Okay? But other things I don't see. So, as I told you before, how to use put options is good for a lot of people because a lot of people, they told me, oh, all the stocks are going down. Okay, if you are looking at many stocks that are going down, you can buy put options instead, and that's it, and you can make money. But don't tell me when you buy put option the stocks are going up. This will be a very hard puzzle to resolve. Okay. So and people, they are like most of the time they are very frustrated when they buy 2 times or 3 times or 4 times they buy stocks and they lose money. They are very frustrated. Now understand that losing money, little money, is part of the game. When you bet on a stock, understand that you can lose money. So there is no a sure thing when you buy you will be making money. There is no sure thing. So stop stressing yourself out and making problems to yourself, because no one is doing this. Okay? Everything we do is about probabilities. Okay? So you are not going to get all the stocks good. You get some few that are not good. Okay? So thank you very much right now. I think I have finished what I want to say about put options. More details if you want to go to see the 2 training that I have about options. Now Hassi said, yeah, don't go into the market forcing a put or call trade with a trend. Yes, it depends on you. What is your strategies and what is your techniques? Because making money is basically where you buy, either put or call, or you go long or you sell short. What determines that you make money is just where you buy. Okay? If you buy at the end of the trend and the trend goes down, you lose money. But if you buy at the beginning, you will be making money. So the buy point is so important. For me, I have techniques to get the precise candlestick that I want to buy. It's precise. Okay? So it's not today I bought it last week. No. If I search today, I should find the stock for today, not for last week or for next week. Okay? Peter Martin said, do you have to buy the stock in a put option to sell back to the... Oh, no. Listen. Peter Martin. I want to understand what is a put option. Okay? Don't think about someone else. Think about yourself. I will make it easy for you to understand. Okay? Don't think about from whom you are buying this put, who is selling this put to you until you buy this put. No, don't think like that, because you make options so complicated. So I will read what you say. You say, do you have to buy the stock in a put option to sell back to the stock? No, you don't buy the stock. Okay. Peter Martin, I will explain again with the diagram. Hope you get what I say. Now, a stock is XYZ. Okay? It is $12 right now. Okay? You see that this stock, this is the chart, it's going down. Now it is $10. Today is $10. Now, if you want to buy 100 shares of this stock, just an example. Now here you are buying the stock, okay? I'm not saying you buy. I will just show you the difference when you buy a stock here you buy a stock. Here you buy a put option. I will make you understand what does it mean. What is the difference? Because stock market and option market is different. Okay? Options have another market. It's not the same as the stock market. Understand that. They are different. But put options rely on the underlying asset. Now, what is this underlying? What does it rely on? It relies on the movement of the stock. Now, you in the stock market, you see that XYZ, this stock, is going down from 12 to 10. You tell yourself, okay, it's going down, and if it continues to go down, I make money. Now, you said to yourself, I want to buy a put option. You go to option chains. This is what we call put chains. You find that today you can buy a put option at, let's say, $1. Now, $1, you know that the ask, when it means when you want to buy $1, it means you are spending $100 on this contract. And this is called a contract. It's not a share. It is a contract. The put option price is $1. Now, when you want to buy, they will ask you to buy, it is 100 because one contract, it is 100 shares. Now, your put options has a relation with how the stock moves. If the stock goes down, let's say to $5, now your $100 could go to, let's say, $200. So you are making money. Okay? So you are making money. Now, I'm not saying you will make $200, but I'm just giving an example. So this is how you make your money. The put, if the market is going down for the stock, you will be making money. But what if the stock is going up? What will happen to you, to your option, to your put option? Your $100, you will be losing a lot of money, and maybe you lose all your $100. Okay, this is put option because you have a few days, 1 week or 2 weeks or 3 weeks for the contract, and it will be expiring. Either you sell it before or it will be zero after the expiration date. After 2 weeks or 3 weeks, according to what you buy. Because when you want to buy, you should see the expiration date. So if you go to expiration date after 2 weeks or 3 weeks or 1 month or 2 or 6 months, your contract becomes zero, worthless. There is no, it is taken from the option market and it becomes zero. So you lose your money. Now, how to make money? If the stock is going down, you will be making money. So for you, you should look at the stock in order just to know if your put option is making money, yes or no, according to the strike price that you bought. So this is in general for what we call the thing. Now, Peter, hope you understand what I say. If still you have confusion, you should ask me another precise question for Peter. Peter Martin, if you have another question that it is very precise, as I explained, you can ask me a question. Thank you very much. No, you just get the idea. If it is still there is confusion between the stock and between a put option, you just tell me. Okay. Hasti said, is there any particular stock you like to trade? I like to trade Netflix. Now for me, I like Apple, Facebook, especially Facebook, because I follow it when it was 1755. That's why I follow it. I follow it from the first day it goes as an IPO. I follow Apple, I follow Twitter, and some other stocks. Netflix is $350 or $400. Okay, so my stocks I buy is like 100, 200, but I can buy smaller ones also. Peter Martin said, how do cash in the option? Now, I don't understand what do you mean. How do cash in the option? I don't understand. What is your question? What is the relation with cash with option? I have no idea. So you can still reformulate your question, Peter, and ask me otherwise, because I don't understand what you mean. Oh, when it's in the money? In the money, it means you buy in the past. That's what does it mean. It doesn't mean nothing else. It means you are paying more for your option because you buy it as if you bought it in the past. For example, you can buy a call option when Facebook was $100. You can. Although now it is 169 or 68. So you buy all in the past. But this doesn't mean that you are going to make money. It doesn't mean nothing. It's just your preference. Tesla said, is Walmart still political stock to avoid? Why you say political stock? Why you say political stock? I don't see. Walmart this year is better because it reached $100. Let's go to Walmart and see, because it's a long time I didn't see. Let's see Walmart. Okay, look at Walmart. We have a very big gap down. From 90 it goes to $110, which is a lot. Now look at 26 December. It was 90, now it was 97. It's the same as the other stocks. But as you can see, Walmart has been going down more than the Dow Jones. Yeah, 1, 2, 3, 4, 5, 6. Okay, you can see that it is going down. Okay, so we will see, because Walmart belongs to Dow Jones, so it's a very big heavy stock, and most of the time it's the same. It's working the same. Why you say political? Because Dow Jones, almost all the stocks are doing the same. So I have no idea what do you mean by political. Okay, you say no problem, Peter. Hasty, yes. Netflix expensive, but I usually buy 2 or 3 out of the money. Oh, you are you mean you are buying? No, I thought you buy shares, but you are buying 2 or 3 contracts. How much is the contract? Because I don't know. Is it like $2,000 or $3,000? Hasty said, You don't like AMD? No, listen, I don't follow AMD. I don't. I know about it, but I don't follow it. Tesla said, which contracts do you prefer, monthly or weekly? Now listen, Tesla, I don't buy options that much. I don't like them because of the risk. Understand that you can't make money when you use $500 or $1,000. You buy 2 or 5 contracts, or you can't make money like this. It's very hard. If you put too much money, the risk is so big, because in options you risk 100% of your money, and the calculations are not the same as stocks. That's why options are too dangerous. Okay? So that's why I don't play that much with okay? I don't play that much with options. I stick always to stocks because the risk is known and the things that change is known. So for me, stocks are better in general. Now, please, if you have more questions, please ask, because we are at the end of this session. It's 12:42, so we have 18 minutes in general. Hasty said 2 or 3 strike prices away from the money, and no, Netflix weekly at the moment is like 500. So if you are buying 3 contracts like 1500 in 1 week, and the market is going against you, you can lose a lot of money from this 1500 that you put for three contracts or so. So it depends if you are familiar, if you like this kind of trade with out of the money. I prefer also out of the money is better than, because you are putting less money into the contract. But if things go against you, you will be losing a lot of money. Peter said, can I get your opinion on Kronos Group Inc? Is this marijuana stock? Because I see it looks like Kronos Group. I don't know. Let me see the I think it's marijuana stock. Oh, okay. Now look. So you see the trend. You see the trend. It stops. Now it's going up and down. So 10, it goes to 20. Now it doubled here. Look. Okay? So here is the trend. But here there is no trend, because it becomes volatile. The stock becomes volatile. So here is the trend. Now if you weren't here and you are here, so I don't see anything that it is good in this stock. And I know it is a marijuana stock because I think I have made videos about marijuana stocks before. Yes, and I put Here is the ETFs, MJ. Yes, it is almost all the stocks have been doing so good. Listen, see? Yes, from 26 December, and this is where the market. This is Dow Jones, so they will be doing the same as Dow Jones for until 4th of February, and then they stop doing good. The same as this one, ACT, Advisor Shares Vice ETFs. These are all the companies in USA, the big companies, and they have marijuana stocks. I have made these videos before for you guys, but I don't know if some people have been looking at them. And this trend is the same as the Dow Jones. And Canopy Growth Corporation also, you see here, 26 December, when and then this is where the trend stops and go down. So this one, Advisor Shares, and Advisor Shares is better than them. This is the best. This is in America stocks and Canadian stocks, I guess, because I find them before, and all are the ETFs. It means you are not focusing on one stock, you are focusing on the ETF, which is a lot of stocks that have marijuana in them. And Peter Martinson, it's a hemp company. Yes, you know, hemp companies and marijuana companies. I have made videos before about them, because Canada is legalized marijuana more than America. America here, they legalize hemp in some states. So Canada legalize everything. That's why they have a lot of stocks, a lot of companies, and in USA we have just few. We don't have that much as Canada. So Hesse said, no, Netflix at the money is like 104. Yes, I know. But usually get 2 or 3 down from the money, which is kind 300 or 200 for one contract. Yes, that's good. So yes, it means you are buying cheaper. And if these things, but 1 week, I don't know if 1 week is good, if except when the Netflix is so volatile in order to make money, because 1 week is just few days. So I don't know, it depends on the target you are looking for. Peter Martin said, the company looked to me as though it was consistent over a few years. What do you mean consistent? Let me see, Khan. So, the Crown company has 3 years in the market. 1, 2, and 3. Yes, it is doing good according to the years. The first year was doing bad. Oh, from 2 it goes to $8 in the year, and then from 7 to 10 and from 10 to 21. So this year, as we have seen, it makes the big deal. But okay, so this year yes is making a new deal. Okay, but listen, here I give you an example. When you buy, let's say, this stock on the January 1st, January 8th, it means the whole year you are making no money. You bought it, for example, at 10.97. 10.97. Okay, in the 9th of 2009 of January. So you are only making money after 11, 9.97. So until here, let's see here, 10.97. What's this? Okay, let's make this 10.97, just to make sure. Okay, I will show you 9.97. 10.97, it means 11. So from this day, 7th of January, it makes the trend. Okay, it makes the trend, but it stops and now is not doing nothing. So from 4th of February to today, which is 8th March, is doing nothing. Okay, so if you are it means if you are an investor, this is something else. So don't speak about years if you are not an investor. An investor, it means you know a lot about this company, you know how much it makes earnings, you understand the competition between this company and other companies. It's a lot of things to see. You should compare this with other companies. Okay? And then you get an idea what stock to buy. It's not just you, because you see it 3 years good, you are going to buy it. You should see other companies. Okay? That's the deal. Now, Peter Martin said, I'm looking at its performance, not so much from the perspective of the index. Okay, that's good. Australian licenses, I believe, will soon be issued for growing, Kareem. So there might be some opportunities, not sure. Now for me, I don't follow marijuana and hemp stocks. I don't follow them. So, because it depends on the momentum. Here in America, there are some companies that they are doing hemp. Some few they are doing marijuana companies. But they are few, because in America there are few states that legalize marijuana. So if other states, okay, legalize marijuana, these kind of stocks will grow so fast because they begin to sell too much. And new companies, they begin working on doing this marijuana production. Okay? So it depends. It depends on the... And are you an Australian? because you say Australian licenses. So I don't know. Jason H, how are you? You come late. You come late, Jason. Can him just follow where the money is? That's it. If the stock is going higher, it's good for him. If not, he leaves it. Yes, thank you very much, Jason H. But in general, I try to avoid some kind of stocks that I don't like that much. Marijuana, hemp, financial, all the real estate. I don't like this kind of stocks. Stocks that has relation with interest rate, money, and banks, and the other I don't like. I like stocks that move faster. This is what I like. Oh, you are in Australia, and is in Australia marijuana is legalized? Because I don't know. I have no idea about Australia. In Canada, yes. Yes. Technology. I like technology. I like drugs companies because they go fast. This is what I like. Most of the time, I like those. Peter said in the past, no. Understand that in Canada, it is legalized. So the companies, you find a lot of companies. In America, in some states. That's why America, if there is legalization in all states, the market will be so big here. But right now, it is not, especially hemp. Hemp companies are small, are very, very small. Because hemp, there is no much as marijuana. Marijuana is another species of plants they use to produce drugs. That's why the people, they want marijuana. They don't like hemp, because hemp is usually used in drug pharmacies, in products, in a lot of stuff. But it is not really used for personal use. Personal use is marijuana. Okay? So we are at the end of this session, and it's nearly 2 hours. So we try to end this session in 1 minute or two. Hasti said, what days do you go live? I have seen some of your videos, but this was the first time I catch you on live. Now, for me, it's Fridays, most of the time on Fridays, sometimes at 10 or 11 p.m. I change sometimes. Okay? And I do short live in Twitch. Twitch. Let's write. Let's give you on Twitch, I do like at 10 p.m. on Tuesday and Wednesday. I want to go to Facebook, but Facebook not yet. I didn't make a program. I didn't make live. I make live one time or two times, but I didn't make that much. Okay. So I see the last question. Last question before I close. So Jason H said, Kareem, did you see BPTH? It went from 18 to 73. Oh man, that's good. I didn't see it. So BPTH. Oh man. This is it goes to 73 and now it is 21. This is a pump and dump scheme. I don't know if it is earnings. So since you see it, Jason, is it an earning news or is it just pump and dump scheme? Yes, it could be a news. What kind of news? Is it earning news? Yes, from 73 to 20. The people who bought it at 70 or so 60 and they go to 20, they will have a problem. Yes, pump and dump scheme is when there is no news. Pump and dump scheme, it is manipulation. But news, it is not manipulation. News, it is just people, day traders find the news, they buy long or they sell short. This has nothing to do with pump and dump scheme. Okay? But I see the stock. I see the stock before, it has done the same. From 84 it goes to 117, and here from 58 it goes down to 42. So see the stock, it was 180 before. Oh, it was 196 before. So this is an IPO. This could have big problems. I don't know what is it, but it could be. Oh, it was $1. $1, it goes to 73. Man, that is a good thing. But you know, hope it is I don't know what is it, if it is earning news or it is some news. Jason said the company announced an update to its phase 2 trial data on prexagerine, a potential therapy for patients with acute myeloid leukemia. Yes. Hasty said low float, high volume. I traded and I got in at 30 and exit at 36 in 8 minutes. Yes. The news are very, very dangerous, you know. Very, very dangerous. But it's okay. If you have made some money, it's very okay. Whatever money you make, you can't know everything about the stock, especially when it's going so wild. So if I see the thing, let's see like 15 minutes. So let's say in 7, from 18 to 27 in 15 minutes, and then here in 15 minutes it goes to 26 to 32, and from 32 it goes to 42, $10, and then from 42 to 64, $22 in 15 minutes. Yes, thanks. But after 15 minutes, it's so bad. But today it seems not that big deal. Okay, things happen. No, it's not. It's Peter Martin. It's not market manipulation. When it is about the news, it's about the news. It is not about. Now, pump and dump schemes is when there is no news in the company. No news. Just the stock goes up or goes down without. Hasty, it took 2 days to reach its high and goes down. Yes, you know, it happens. Okay, so thank you very much, guys. If you have other questions, but who is behind the news? No, he said that the company announces some important things about its drugs. That's why these companies can fly so high. The only time I make a good trade about this is I double my money in 1 day. I bought it at I think 75. The other day it goes to 145 or 150. I double my money in 1 day, but because of the news. Okay, so it's not a trend. So guys, thank you very much for watching, and please go to my website and go to check the put options training if you want more details. Thank you very much for coming here, Nanucci, Martin, Hassi, and Jason, and all the guys that are watching, and see you next time.